What's up, guys? Today we're going to be analyzing Ingles Market. The reason I'm analyzing Ingles Market today is because Michael Blurry, the man who predicted the 2008 recession and short the market, did recently take a stake in Ingles as shown in his last 13F filing. So I thought it'd be a good stock to take a deeper dive into. So let's begin. So Ingles Market is a supermarket chain in the southeast United States. They operate 197 total supermarkets and are based in North Carolina, South Carolina, Georgia, Tennessee, Virginia, and Alabama. A couple things to note before we look at how Ingles makes its revenue. One, the company owns its own warehouse and distribution facilities, which are within 280 miles of all its locations and supply 62% of all the goods the company sell. The remaining 38% comes from third parties and are delivered directly to the store. Secondly, the company even owns a milk plant which supplies 80% of the milk products in the stores. The plant does even offer another revenue stream for the company as it sells 71% of its products, but as we're about to see, this revenue stream is not high. So let's take a look at the revenue streams of Ingles. So on this pie chart, grocery includes groceries, obviously, dairy, and food products. Non-food category includes alcoholic beverages, tobacco, pharmacy products, and health, beauty, and cosmetic products. Perishables include meat, produce, dairy, and bakery, and finally, gasoline is very self-explanatory. So as you can see here, the major contributors in Ingles' revenues are its groceries, perishables, and non-foods. However, it's even important to note that Ingles' profitability is even tied to gas prices, since gasoline does make up a good portion of its revenue. So if you do decide to take a stake in the company, you will be exposed to global gas prices. So let's look at how the company plans to expand. So I began reading the 10Ks in 2012, or not in 2012. I began reading the 2012 10Ks up to 2020. So the renovation and expansion plan that they mentioned has been the same throughout. So basically, their expansion plan is pretty simple. They basically plan to add more stores and modernize existing stores. So the first thing, add more stores. Ingles has definitely fallen short here. Its store count went from 2004 and 2012 to currently 197 today. The company states that their store count is decreasing because some store locations do not meet their high standards for appearance and design. Not exactly sure how this is true or how much I really buy in this, as much of it I think it's just an excuse. Uh, but Ingles has definitely grown its revenue per store, which is good to see. They've grown their revenue per store at a CAGR of around 2.61% since 2012, which has given Ingles a sustainable revenue growth of around 2.8%, of an average of around 2.8% year over year. So let's take a look at Ingles' revenue. So, as mentioned, Ingles' revenue has been growing since 2012. Uh, Average of 2.8% year over year, but a CAGR of 2.42%. So this is in line with both the industry and the economy in general. Ingles is definitely not a growth monster, as we can see here. It's a grocery store, so it's not like a technology company that's going to have high double digits revenue growth. It's important to note here that COVID has definitely given the company major tailwinds with revenue growth being around 9.7% from 2019 to 2020. So if we remove that from the equation, we have a CAGR of less than 2.42%, which is not great. Okay, let's take a look at the grocery store industry. So this discussion wouldn't be too long because, first of all, grocery stores are not a complex industry compared to other industries. I'm not saying they're not complex, but they definitely do have a lot of complexity in macroeconomic trends, but they're not as complex as other industries, in my opinion. And secondly, Ingles really has no competitive advantage in it, which is why I'm not taking too long to discuss here. So the grocery store industry is expected to grow at a compound annual growth rate of 5% from 2020 to 2027. I personally believe this number is a little high, but people who are much smarter than me and who've been studying this for a long time have come up with this number. I will be using a smaller number in my valuations. Anyway, so two major contributors to how well a grocery store does comes from price and convenience of store locations. So number one is how well priced the products are, and number two, how close the stores are to customers. So Ingles does have a small degree of price control with their because they produce their own brands. However, they are a much smaller company compared to some of their competitors like Kroger, which we will be analyzing in a second. So this does decrease their pricing power a little bit. Additionally, e-commerce and groceries is becoming more and more relevant today. For example, Walmart has expanded online distribution facilities and has started doing same-day delivery since 2019. Kroger has its own pickup sites and even does online orders through Instacart. And obviously, Amazon in 2017 did acquire Whole Food Market and they do deliver groceries. So I was a little disappointed to see that Ingles has taken no initiative in the realm of e-groceries. Management has stuck to its store locations and pickup with no plans on enlisting with platforms like Instacart or doing their own deliveries. I personally think e-groceries will be a much larger business 10 years from now, and I do think Ingles will fall behind if they do not start making plans for grocery shopping online. Personally, for me in college, I do pay the $10 weekly to get my groceries delivered to me. It's a big time saver and it's very convenient, and it is worth the $10 in my opinion. So let's take a look at some of Ingles' competitors. So Ingles does have many competitors. The supermarket industry is very competitive. Uh, and they are even characterized by narrow profit margins, which we'll see in a second. But the main competitors we are going to be comparing Ingles to are Kroger, Wise Markets, and Sprouts Farmer Markets. Kroger being the largest at a market cap of 28.57 billion, and Sprouts and Wise both having market caps similar to Ingles. Well, I guess Sprouts is actually double Ingles, or more than double Ingles, but much more similar than Kroger. So let's take a look at what we find in our analysis of our competitors. So let's start by comparing profitability. So right off the bat, I already don't like what I'm seeing with profitability. Ingles has grown its revenue, as I mentioned, at a CAGR of around 2.42%. This is in line with the economy and inflation in general, but is much lower than Wise, Kroger, and Sprouts Farmer Market. Sprouts Farmer Market, who has a monstrous growth of 15.3%, which is fantastic for a grocery store. Next, let's look at the profit margins, and margins we're using here is net profit margins. So again, I don't really see any clear competitive advantage Ingles has in the supermarket industry. The recent 2020 margins is higher than Wise and Kroger. However, it still does not compare to Sprouts Farmers Market. This was really surprising to me actually, since they do have ownership of their own warehouse and milk processing plants. So I did think that would give them a bit of a competitive advantage, but apparently does not seem that way. So let's move on now to look at how Ingles does with debt. So a quick side note, I do like using EBITDA as a metric for a company's financial performance because it gives an even playing field to measure companies with a different financial and tax structures to others. And it can be used as a proxy for cash flow, although it's important to note that it is not cash flow because it does not include capital expenditures. So for net debt to EBITDA, which is our ratio we're going to be using here, I do like to see a ratio of less than 3. Less than 3 because this is a standard conservative level of debt that a bank would be looking to put on a business. So Ingles has definitely decreased their debt throughout the years, and we are now at our required net debt of less than 3x. However, they still don't stand out from their competitors. Wise Market has no debt whatsoever, which is fantastic. And Sprout Farmer Market even is slightly worse than Ingles in this ratio, but as we just saw, they do have the better profit margins. So definitely not seeing any advantage in debt from Ingles. Next, the final ratio we're going to be looking at is comparing Ingles' return on equity to his competitors. Formula being net income over shareholders' equity. This is a very important ratio that helps us understand how well management has been doing in allocating the capital we as shareholders are giving to them. So the higher the number, the better. So Ingles is definitely moving in the right direction here, with their return on equity increasing from 9.8% in 2012 to 24.1% in 2020. However, they still lag behind Sprouts Farmer Market, which currently has a 39.3% return on equity, which is absolutely fantastic for grocery stores. Maybe there should have been a Sprouts Farmer Market video instead. But anyway, let's continue. So I even include the average here of return on equity because some experts, like Tobias Carlos, do consider these ratios being mean reverting. I'm not really exactly sure how much I agree with it, but he's done a lot of quantitative research into this, and he does believe that. And in case you do, the averages are there for you to check out. So overall, return on equity for Ingles, not disappointing at all. But again, I'm not seeing a shining star company here when it's compared to its competitors. So let's see how all these financial metrics have worked out in Ingles' pricing and valuation compared to its competitors. So We will be using EV to EBITDA here to value Ingles compared to its competitors. EV standing for enterprise value. So enterprise value tells us the firm's total value, and it's market cap plus debt minus cash. So EV was definitely confusing for me when I first learned about. I didn't really understand why we add debt and subtract cash to tell us the firm's total value. I can maybe make a video on it in the future, but in short, enterprise value tells us the firm's total worth from the perspective of someone looking to buy the firm. When you're going to buy a business, you're going to buy all the debt as well, while the previous cash is going to go to the prior owners. So the metric to EV to EBITDA gives us an indication for how long it would take us to buy the entire company with the current operating income. I do not really see any market inefficiencies here. Ingles is priced similarly to Wise Market and less than Kroger and Sprouts Farmers Market, which does make sense. As we saw, Sprouts Farmers was characterized by incredible margins, low debt, and a monstrous return on equity. Kroger's pricing is a little high to me, in my opinion, but I think that's primarily due to it being the most well-known supermarket brand, and giants like Warren Buffett putting their capital behind the supermarket. Finally, Ingles is priced similarly to Wise, which makes sense. While Ingles does have the better margins and return on equity, it even has more debt and less of a track record in terms of revenue growth than Wise. So let's continue and try to forecast what we think Ingles' price would be worth. So this type of forecast I'm about to do comes from Cameron Stewart. I really like his method of how he forecasts stocks, so that's why I'm using it today. I can maybe make a more detailed video on how to do this maybe later, but let's begin. So I'm definitely not going to go over this entire chart because this video will be much longer than it already is, but the major numbers here to keep in mind is our average EBITDA growth of 3%. This does exclude 2020's EBITDA numbers because those received major tailwinds from COVID, and they're most likely not going to continue. Additionally, here we do have an average EV to EBITDA of around 6.52, which I will be using as an exit multiple when I'm forecasting. It does exclude 2020's 3.4 EV to EBITDA, just because at that time the company did just buy back shares, so it made the EV to EBITDA much lower. So if I'm going to try to find an exit multiple, I'll give Ingles a bit of a higher multiple to exit with, which does not really make a difference, as we will be about to see, as we will be seeing in the future. So next, I will be doing two types of forecasts, one based on EBITDA, one based on cash flow. So let's take a look at the company's cash flow. Again, I'm not going to go over the entire chart. You could pause the video and take a look at it if you want. But the major numbers here that we will be using in our forecast is an average free cash flow yield of 5.3%. So with that in mind, let's forecast. As mentioned, two forecasts, one EBITDA base, the other free cash flow base. I'm going to take both prices I get from each forecast and average them together. So let's start with the EBITDA base forecast. So we're going to grow our EBITDA at a constant rate of 4% every year. Supermarkets do have a consistent and sustainable growth. Therefore, we keep our 4% number throughout the 10-year period. I use 4% because even though that the average was 3% as seen previously, our industry research did tell us that supermarkets are expected to grow at a compound annual growth rate of 5% through 2020. So I averaged the two together to get 4%. So we grow at 4% 10 years, and then we apply our exit multiple of 6.52 to get the enterprise value of the firm in 2030. Subtract that, add cash gives us the market cap in 2030, and finally we divide by the shares outstanding to give us an EBITDA focused forecast for Ingles stock price in 2030 being $102.71. Okay, let's look at our free cash flow forecast. Similarly, I'm going to be growing at a rate of 4% every year. Like I mentioned, EBITDA is an okay proxy for free cash flow, so growing free cash flow at 4% year over year isn't a terrible idea. So after we get to our 2030 number, we apply the 5.3% free cash flow yield to get us from our free cash flow per share to our 2030 stock price of $64.29. I mean, sorry, my bad, of $67.14. So I average these two together to get a 2030 stock price forecast of $84.92. This would provide us with a 3.71% compound annual growth rate on our initial investment, which is not market beating at all. It is important to note here that Ingles does pay a dividend of around 1.12% if you buy it at $59, which is around where it's currently trading at. Management has stated that they don't plan on increasing the dividend anytime soon. So again, we're not planning to get a market beating investment according to my forecast. Overall, Ingles is a pass for me. Did not stick out in comparison to their competitors, both quantitatively from the metrics we saw, and I could not find any clear qualitative advantage that would give them a so-called moat. Additionally, their EV to EBITDA seems very reasonable against their competitors, and our forecast, well, just my opinion of an estimate, does not seem to give us a reasonable return on our money. A couple of things I'd like to add before completely writing Ingles off for you. Ingles management is absolutely fantastic. It is exactly what you're looking for in a management team. The CEO began working for the company at age 16 as a clerk and eventually became the CEO at 35. He's never worked at another company in his entire life, which is pretty impressive, actually, in my opinion. Unfortunately, the founder of the company did die in 2012, but his son, Robert Ingles, took over. He began as a CEO, but is now the chairman of the company. He does hold roughly 29% of common Class A and Class B shares, which you love to see. You want to see a high insider ownership to a business because that means management interests are aligned with shareholders. Finally, Ingles has been buying back stocks over time. Our forecast assumes that the shares outstanding will remain constant at 18.9 million for the next 10 years. This makes our estimate a little more conservative, which I always like to do, but however, it's not likely to remain true since management has bought back stocks 2 times in the past 9 years, which is, again, something you really like to see management doing. You like to see them having the shareholders' interest in mind. So there most likely will be buying back stocks again in the next 10 years. Anyway, these are just personally my opinions of the company. It will be a pass for me. If you liked this video, please leave a like. This type of research did take a lot of time to do. It took a long time to read through 9 annual reports, do industry research, compare the metrics, and do a forecast. So I would really appreciate the like. If you have any questions about anything I've said, leave a comment, and thank you very much.